I want to welcome you all to this event in which we will discover how we get to tax reform, which I can't wait to hear. I want to start with some thank yous. I want to thank Roseanne, who was the motive force behind this idea of commemorating the 10th anniversary of the Bush tax reform plan, and her partner, Jeff Kupfer, Chief of Staff on the panel, and John Ackerman, Chief Counsel, who did amazing work on the report and also had the idea for this event. They all worked hard together to put together the program and recruit the exceptional panel who we will hear from later. I want to thank also Chelsea Krim, Jesse Zora, Joanna Teitelbaum, and Blake Green for organizing the logistics, which are always harder than you imagine. And when it looks like it's really easy, that's when you know that they worked especially hard. And it looks pretty easy today. The Bush tax reform panel was the first serious high-level effort at comprehensive income tax reform since the Tax Reform Act of 1986. I was a bit skeptical of the effort at first. The panel only included one public finance economist, admittedly an absolutely brilliant one in Jim Paterba, and its ground rules called for matching the revenue of a so-called extended baseline, assuming that the Bush tax cuts would be extended after their scheduled expiration in 2010, which meant that a large tax cut would be built into the baseline. I should point out that this was clearly the right answer because Jason Furman lobbied me furiously to choose that as our baseline when we were scoring Obama's tax proposals during the campaign. The panel and its staff and Treasury staff worked tirelessly, taking testimony from many, many experts and citizens, and produced a truly astonishing report, which, if acted upon, would have produced a simpler and more efficient tax code. Actually, there were two options, either one of which would have been a big improvement on current law. The report also debunked some popular shibboleths, like the idea that a 23% national retail sales tax could replace all existing taxes without blowing a hole in the budget. And even though the plan didn't lead to legislation, the panel's report is a fantastic reference work for anyone who wants to think about tax reform. Our plan here today is not to engage in a nostalgia fest, but I did want to acknowledge what this panel and staff accomplished. I'd also like to remember for a moment one of its members, Bill Frenzel, who devoted his life to public service, first as a politician, including as a longtime member of the Ways and Means Committee, and later as a Brookings Fellow and a world-class doodler. One of his doodles is in the executive summary of the panel report, which you have in your packet. I think everyone who knew him misses his intelligence, kindness, and sense of humor, all of which sometimes seem to be in short supply in the current political debate. I have the great pleasure of introducing our keynote speaker and moderator, Howard Gleckman, Senior Fellow at the Urban-Brookings Tax Policy Center and editor of our blog, TaxBox, who will moderate the session. Our keynote speaker is Jason Furman, who is the 28th chairman of the President's Council of Economic Advisors, where he serves as President Obama's chief economist and a member of the cabinet. He has served in the Obama administration in various economic roles since the beginning of the administration. I had the good fortune of working with him when he was deputy director of NEC in the Clinton administration, and I was at Treasury DAS, and we always agreed on policy ideas. Jason also was a Brookings Senior Fellow and an early TPC scholar, and I think helped us to establish our reputation as reliable and high-quality analysts. He's a terrific economist who has a knack for explaining complex economic concepts simply and clearly. He does a better job of translating good policy into good politics and vice versa than anybody I know. I'm so grateful that he's agreed to talk with us today. Jason.
Thanks so much, Len. It's really great to be back at Brookings. Not a lot has changed since I was speaking in this very room yesterday morning. But the crowd is just a testimony to how much incredibly serious and great thought goes into tax policy and tax reform. And the Commission's report, I remember, how serious the hearings were, how terrific the report was. I've used it in my teaching. I still refer to it. And I think by saying all of that, I'm now giving the first official comment from the government on the Tax Reform Commission, unless you count the "we're still reviewing it" comment that was made 9 years and 11 months ago. What I wanted to, you asked me to come talk about how do we get tax reform. And I think the reason you thought of that was that I've been working on the topic for the last 7 years in government and on and off after that. I have a bit of bad news for you, which is we haven't gotten it. And so, to some degree for me, you can do an econometric exercise to figure out how to get tax reform and work on a variety of models, and it turns out a year fixed effect model, with the year being 1986, is the model that fits the existing data better than just about any other one, but not something that gives us a whole lot of insight into what to do next. I don't want to be overly negative. We actually, I think, in some ways have made progress in the tax code, and if you think of the tax reform panel as setting out a North Star, I think we've moved a little bit in that direction. One way we've moved in that direction is the tax reform panel proposed to cap the exclusion for health care at, I think it was the average premium for health insurance. And that's based on a theory that is widely accepted in the economics community, that if you create a tax advantage for one form of consumption over another, you'll get too much of one, which is health care, too little of the other, which is consumption and wages more broadly, and you'll make people worse off. Through the Cadillac tax, we were able to do that. We set the threshold considerably higher, but that threshold is indexed to the CPI, so it would be expected to phase in over time. It's something that would reduce health spending by about $60 billion a year, raise wages by about $45 billion a year, which is a relatively large and important impact, and one that has been supported by economists from across the political spectrum. The tax reform panel suggested more automatic enrollment in 401k plans, taking advantage of research on behavioral economics and some of the complexity of a system in which people have to make their own choices about retirement. And that was something that President Bush signed into law in the Pension Protection Act in 2006, and we've done further executive actions to push it forward. We have more certainty in the tax code today than we had when the tax reform panel worked. We've taken some of the temporary tax cuts and made them permanent, some of them for high-income households and let them expire, and we've indexed the alternative minimum tax to inflation so that it is a more sustainable basis. But I don't want to overstate the degree to which any of those have transformed our tax system. Obviously, they haven't, and obviously there's a lot more that remains to be done. I want to ask the question of why it's been so hard to get tax reform, and in asking that question, see if we can develop any insights that'll help us in actually getting it in the future. The classic explanation is grounded in the logic of collective action, that whenever you create concentrated costs and diffuse benefits, you have a political challenge on your hands. I think the problems go even further than that, because it's not just, this industry is hurt, the economy as a whole benefits, but even within the same person, if they get the benefit of lower rates and the cost of a broader base, often they understand the thing they lost, that base broadener, more than the dollars they're getting from the lower rate, or they believe one more than the other, and you can't overcome that as well. The question is, what do we have that can overcome this logic of collective action and then this almost analog to it at the individual cognitive level? And I can think of 4 possible ways out of it. The first is to hold another Brookings event. We will test that proposition today. The second is organizing yourself around a broad ideology that helps you overcome all of the particular interests. I think that's possible that we could see something like that, where just people believe it enough that it overcomes it, but it's had challenges. You saw at the beginning of this, at the beginning of the century, we saw Republican control of the presidency, the House, and the Senate for most of a 6-year period. You didn't see any serious effort to reform the tax code during that period. Today, on terms of business tax reform, you have, if anything, an ideological view on the left that why would you want to give something to businesses, and on the right, why would you want to give something to businesses, and without doing something for individuals too. And so I'm not sure how far that's going to be able to take us. There's a third way to overcome the logic of collective action problems, which is cheating. And if you, for example, have a lot of Roth IRA realizations, like conversions up front, and lose money in present value over the long run, or you take advantage of time shifting like depreciation rules or things like that, you can have something that purports to be revenue neutral within the budget window. Sophisticated actors, especially on the business side, understand that it's actually revenue losing in present value, and so you can create more winners than losers. The problem with the cheating route is, one, it's not something that our administration is going to go along with, and has been very clear about that. And it's not something that we should go along with, because the costs associated with the additional deficits over the long run will likely outweigh any of the economic benefits associated with tax reform. So the fourth route, and the one I want to spend the most time on, is that even if you're doing revenue neutral reform, so that in a revenue table on your tax forms, the number of winners in dollar terms equal the number of losers over the next decade, that maybe in some deeper welfare sense, the number of winners outweigh the number of losers. And that's, of course, possible if you're able to improve the efficiency of the tax code, if you're able to make the tax code simpler. And so the question is, how far can that take us, that you can create something where the economic winners outweigh the economic losers, even if in terms of actual dollars and cents, you don't have that? I think there's some potential for that, and I think there may be the most potential for that on the business side of tax reform. And as an aside, I think it's interesting that since the tax reform panel wrote, the conversation on business tax reform has moved a lot further, and congealing around a certain idea of what you'd want to do, although not congealing close enough that we're going to pass it this year. But an individual hasn't. And the tax reform panel had business rates of 31.5% and I think 30% in the two plans. And if you look at the president, we've proposed 28%. The main congressional proposals are 25%. And then in the campaigns, you see even lower numbers than that. So the whole conversation on business has shifted a little bit more to business, and has shifted to lower rates than what was under discussion on the business side a decade ago. And I think that makes sense. but given what we've seen in the trend in tax rates globally. An example of how you can have economic winners without having a corresponding revenue loss would come from the international tax system. And that's a tax system that some textbooks describe as a worldwide system because it taxes you on income you earn anywhere in the world. Here in the United States, it's a tax system that in practice I've described as a stupid territorial system because you don't actually ever pay those taxes on the income that your CFCs earn on their overseas income. While we don't collect any revenue, we do manage to impose substantial distortions in the form of locking out capital, reducing some of the flexibility companies would like, and that suggests that there is some market clearing rate, you could think of it in a minimum tax framework that we've proposed, that we could collect more revenue, companies could have less cost and more flexibility, and everyone would be better off. I think there's a number of other examples like that in business tax reform that would come from making a tax system that was more neutral, not just in domestic versus international location of businesses, realization of profits, but in debt equity, where we have a spread of 40 percentage points right now between the tax rates on debt and equity, between the corporate and non-corporate form, where we have a spread of about 6 percentage points between those two, and a spread that, by the way, tells us we want to be cutting the corporate rate more than we're cutting the individual rate. So the economics of business only makes sense when you think of it on an integrated basis. And so I think this logic to me feels quite compelling on the business side. I would note that businesses, in my experience, are inconsistently persuaded by that logic. I've never met a corporate tax director who isn't incredibly enthusiastic about us using dynamic scoring to relax the revenue constraint over the next 10-year window. I haven't met that many corporate tax directors that use dynamic scoring in evaluating the effect of business tax reform on their own companies. They tend to look at, what did we do last year? If this new set of tax changes had been in effect, would our taxes have gone up or gone down? And I think until, we think more broadly about what the economic benefits of tax reform are and incorporate those into the analysis, not just, in a sense, the static analysis from the business perspective, we're going to have a hard time using that logic of more economic winners than economic losers in a revenue-neutral reform to propel it forward. I want to turn now to the individual side and risk being a little bit unfashionable in a room and a setting that is about a very serious and a very thoughtful individual tax reform, to say that I'm not entirely sure how quantitatively large the more winners than losers is on the individual side, and that frankly leaves me a little bit more enthusiastic for looking at the distributional impact of tax changes, which strikes me as often quantitatively large relative to some of the efficiency and simplicity. I don't want to overstate that point. I think there's a lot we can do for efficiency. I gave the example of the high premium excise tax on healthcare. There's a lot we can do on simplicity, but I'm not sure if they're going to add up to anything close to the winners and losers. To talk first about the evidence on growth. One of the most comprehensive simulations of comprehensive tax reform from Altig et al. In the AER, I think 2001, found that a flat tax with transition relief, which is sort of beyond the outer edge of what I would think is politically possible, would raise growth rates over the first 15 years by 3 basis points per year, and would raise growth rates over the next 135 years by 1 basis point per year, and after 150 years would leave the economy 2% larger than it would have been in the absence of reform. The same All-Take-It-All paper finds that if you do a proportional consumption tax with no transition relief at all, and the same flat rate applying to everyone with no standard deduction, et cetera, then after 150 years, you'd expand the economy by 9%. Bob Carroll's analysis of the Tax Reform Commission found that the simplified income tax plan would have raised growth by a negligible amount and would have raised, and the growth and investment plan would have raised it by, I think, a tenth or 2 or 3 a year. I don't think we want to sneer at tenths. I've, in the context of trade, have pointed out and argued that something like the Trans-Pacific Partnership is estimated at 0.4% of GDP after a decade. That's $75 billion a year. And it would be irresponsible for an economic advisor not to tell the president to sort of stoop down and pick up $75 billion a year that's lying on the sidewalk. But if you're asking the political question of is that going to be enough to overcome the impediment, I'm not sure. I think we have a challenge there. The challenge is deepened by growth isn't the right way to think about the question. It includes something it shouldn't and omits something that it should. What it includes is if you work a lot of extra hours to produce that extra national income, you have a disutility associated with that hours, less time with your children, child care expenses, transportation, and the like, and so we shouldn't equate that with welfare. On the other side, you can have things like the high premium excise tax for health care, where we have a benefit that doesn't necessarily manifest itself in terms of larger national income. It manifests itself in terms of a more efficient allocation of consumption. The problem with more efficient allocations of consumption, I can tell you from personal experience, is you don't get a lot of thank you letters for policies that lead to them. The next area is simplification. And I think the awkwardness for tax reformers here is that we love going through that list of tax expenditures and talking about how many they are and how much they add up and how terrible they are. About half of those tax expenditures are exclusions. And exclusions are making it easier for people to measure their income. So we could get rid of all of those, move closer to a Haig-Simons tax, thrill a lot of people in this room that we are now taxing home production and imputed rent. And you wouldn't necessarily make tax filing any simpler. We've done some work in the administration that has basically confirmed that if you look at the number of hours, that the bulk of the complexity in the tax code comes from the measurement of income, where you have a real trade-off between some of the sort of rough justice from omitting the things that I just described and some of the efficiency that tax reformers would like. The deductions, mortgage, charity, state and local, and the exclusions the deductions tend to be a much smaller source of that complexity. Some of them, like the mortgage interest deduction, isn't particularly hard to do at all. Moreover, you don't get any simplification benefits from reducing a deduction. You have to eliminate it entirely, and many of the tax reforms would reduce it. That's not to say we can't simplify, but I think some of the simplification isn't going to be from the classic base broadening, but is going to be steps like ones we've taken of having universities report to students the information they need to claim their tax credits for education and other things that make it easier to file and prepare your taxes. Finally, we come to distribution. And this was beyond the mandate of the tax panel for understandable reasons. It was charged with being distributionally neutral. There's an appeal to distributionally neutral because we can all agree on it. And I think one of the ways in which business tax reform could ultimately be easier is it doesn't get you into those debates over distribution and over revenue. But when you look at distributional questions, it is very easy to have a tax policy that takes people at $20,000 or $25,000 a year and raises their after-tax income by 5%, which is way more than those numbers after 150 years on the growth effects that I was giving you for a flat tax with transition relief. And it's easy to lower after-tax incomes for high-income households by 2-3%, and to do all of that in a revenue-neutral manner. Now, I'm not saying everyone in this room thinks that's a good idea or thinks that's a bad idea, but there's a set of tools we have that in some sense, more quickly, more reliably, have very large and meaningful effects, and that's why I think we have very large and meaningful debates and disputes over those distributional issues. But if we're trying to do something about the income of the bottom third, the middle 20%, the bottom 90%, whatever it is, I don't think we're going to necessarily be able to do it with reform that's constrained to be distributionally neutral, because I don't think the other benefits are necessarily going to be large enough to overcome the impediments. Want to wrap up by trying to talk about where we can go from here. The first is I continue to think that business tax reform is very important, that there are potentially a number of benefits, and that if we can, and that by taking you out of that distributional debate that I think is almost inevitable on the individual side, there's potential to make more progress on it. I think that progress is going to come about if we detach the business debate from the individual debate, because if you're in a conversation about how to lower all rates to the same number, that number is going to be 39.6 for individuals and 35% for corporations. If you're willing to separate those two and think about it from an economic perspective, which is on an integrated basis, what's the tax rate on C-corps, what's the tax rate on pass-throughs, I think you have an economic logic for separating and a political logic. Second, I think there's a number of steps in the tax code where there is common ground. I think the childless EITC is a great example of that. It's something the president proposed to expand in his budget, a proposal that now Speaker Paul Ryan adopted coming out of his process and thinking about poverty, and one that you see presidential candidates from both parties supporting. And my guess is the next time we're making changes to the tax code, that's one of the changes that we'll be making. I would suggest, adding to that list, some other items. When you think of step-up basis for capital gains, we've proposed it in conjunction with raising the rate on capital gains to 28%. So we both change the way capital is taxed, but also change the level of capital taxation. Those two halves of the proposal are to some degree separable, and I think there could be a greater degree of consensus that you want to avoid lock-in of capital gains. That's one of the ways in which there's an economic cost that's not incurred as a commensurate benefit to the Treasury in the form of revenue, and you can improve the system and then, after that, argue what the level of capital taxation is. Finally, I don't think we should give up on individual reform. I think the goal of improving efficiency, the goal of improving simplicity are important, but having reforms that you can break off pieces of and do them as steps along the way, I think is important. Finally, I think there's a lesson, for those of us in the policy community and in the economics community, which is that we should be more, even more serious and frank about what the upsides and downsides of different approaches are. And if we get that analysis right, it will both help guide better policy, but also maybe help even identify some of the obstacles to why policy does and doesn't happen. I think, for example, looking at more dynamic distributional welfare analysis of tax changes would be welcome. And what I mean by that is you have the analysis of the tax change itself, the traditional distributional change. You include the dynamics in it, so any changes that result from that tax change. You include on a welfare basis, so if somebody works an extra hour because you reduce the tax wedge, that's counted as a welfare improvement, but not dollar for dollar with what they earned. And if GDP doesn't go up because you get wages instead of health care, that's also counted as a welfare improvement, although again, not dollar for dollar with the increase in wages. So it would look at welfare, not just at income. And then finally, it would take seriously what Bill Gale and Peter Orszag and others really pushed for years, which is looking at the financing. It's really easy to make everyone better off if you're ignoring the way in which it's being paid for. So integrating the financing, the welfare, the dynamics, and the distribution, all four of those factors, to evaluate and think about tax reforms and help guide us to which ones are going to serve whatever objectives we have. And I laid out some of the ones I had. The second thing would also be to take more seriously the modeling of complexity, that how many hours are coming from which parts of the tax code. If you make this set of, if you get rid of every tax expenditure, what have you done to the number of hours? Has it gone up or gone down? Which ones are the most complicated? And not to just do that at a superficial level, but to sort of roll up your sleeves and think harder about where those sources of complexity are. I want to end with what I began by really thanking you all for a terrific report, a report that I've read several times, and that I would love to see continue to guide thinking in the future. And I'm really glad that we're coming back and talking about it again 10 years later. So thank you. So, am I standing here today? Leaving?
You're not leaving. You're not getting off that easy. We can maybe stand. I don't know. What do you think? Okay. All right. Good. So thank you very much. Big analysis. Can you all hear me? How's that? Okay. Let me ask you, if I can, start with the bottom line question. You said that there would be no tax reform this year. Well, there's only 3 months left in this year. I think we all knew that. What about business tax reform next year, in 2016? Is this an important enough issue to the president that this could happen in some form in 2016, or is this something that's going to have to wait?
It's something we'd always love to happen. He put it on the table in his State of the Union 5 or 6 years ago, was the first president in decades to call for cutting the corporate tax rate, followed up with a framework for tax reform. There were a set of high-level discussions that I think in many ways converged around a framework in terms of roughly where the rate is, roughly how you're paying for that rate, that on the international side you'd have a hybrid system that wasn't pure worldwide or pure territorial, that you'd take seriously integrating especially small business pass-throughs into your thinking about reform. The big hang-up was the question of whether the individual rate needed to be cut in conjunction with the business tax rate. And as I said, I think that's impossible within a revenue-neutral, distribution-neutral reform. And I don't think it's necessary in a world where you're retaining capital gains and dividend taxation. You shouldn't have the same tax at the first level for businesses and individuals, and there's other ways to deal with the pass-through. So I think, that, impasse is what has been standing in the way of it, and I'm not the one who can give you the most insight into when that impasse and how it could be broken.
Okay, thanks. Want to give you all a chance to ask questions. A couple of guidelines. Please introduce yourself, wait for the microphone, and please make your question a question and not a speech. Jason's the only one who gets to give a speech this morning. So let's let maybe Bob can start. Yeah, they need the mic for the,
Oh, you're getting one.
There we go.
My name is Bob Posen. I teach at MIT. I just following up on your point about pass-throughs. So we know that the corporate tax rate reduction from 35 to 25 doesn't help pass-throughs for obvious reasons, and you don't want to, for good reasons, don't want to get into the debate about the top rate. What can you do for pass-throughs that would make them support business tax reform other than reducing the rate? Because they're going to feel, rightly or wrongly, that you're helping the big guys and not the small guys.
So if what you're talking about is small pass-throughs, $25 million of income a year, $50 million of income a year, then I think you can take care of them. And we've proposed things like expanding Section 199, Section 179. We've also proposed expanding 199 for a different reason. Expanding 179 expensing. And one of the principles of the president's framework for tax reform was that it should simplify and cut taxes for small businesses. So that I think we can do. If you're trying to look at the pass-through sector as a whole, including large pass-throughs, I don't think you can do that, and I don't think you should do that. Again, if you look at either the Treasury or the CBO rates, and I'm rounding here, on an integrated basis, C Corps are taxed at something like 28 or 29% because you have some tax at the first level and some tax at the second level. You add those up. Pass-throughs are taxed at 24%. One of the goals of a tax system is to have tax rates more neutral over different types of activities so that you're undertaking those activities for economic reasons, not for tax reasons. And so if you're trying to lower everyone together, you've undone the whole point of tax reform, which is creating tax rates that aren't distorting decisions in the way that they're distorting them today. So I don't think you want to necessarily overcome the large pass-through problem, and I don't think you can.
Other questions? Yes, sir, right here.
I think Alan Dworsky, a retired equity investor, this summer I happened to hear Professor Gordon of Northwestern speak, who is writing a book which will be out, I guess, in the coming year or so, about the changing character of the American economy. And at the high end, leaving out small companies, the larger, mature companies that have been put together with acquisitions and mergers and multi-divisions, one wonders, in a slow-growing economy at the high end, for various reasons, what the real need is for corporations to have more money. If they have more money, they'll be paying larger salaries. There's no question about that. It's not clear that it is going to stimulate the growth of the economy. At the low end, yes, it'll help small companies finance their innovations and growth more rapidly. So I suggest a distinction between large, mature, multi-aggregated companies who don't really need the money in a slowing economy at this time and for the foreseeable future versus the small companies.
Right. Just to be, I think I got the drift of your question. And what I was talking about and what the tax reform panel was talking about a decade ago was revenue neutral tax reform. So I'm not talking about collecting more or less taxes from businesses. It's just, collecting them in a less stupid way. And I think businesses are critical to job creation and raising income. And if we have a less stupid way to collect taxes from them, we should do it.
Okay, other questions? Bill?
Thank you, Jason. Bill Gill, Brookings Institution Tax Policy Center. Thank you, Jason, for being here. Your last comment about raising taxes in a less stupid way leads directly into my question. We talked about tax reform as if it's only income tax and corporate tax. What about a carbon tax? Is there any chance of working that into a reform, perhaps in a revenue-neutral way?
That was beyond the purview of what the tax panel considered, and so I'm going to try to limit myself just to things that were in the tax panel report today.
Good non-answer. Thank you. Let's way in the very back, behind the cameras.
David Brazel. Jason, I was struck by your statement that almost all economists think we should be taxing medical or benefits. But isn't health expenditure, could you not liken that not as consumption but as maintenance of human capital, or perhaps even investment in human capital, that it's not equivalent to a trip to Wally World? And therefore I'm not really balancing consumption versus tax consumption versus non-tax consumption, but a maintenance expenditure which should be deductible under net income tax rules.
So, first of all, I think my specific statement that most economists support that was factually correct. Whether most economists are correct is the question that is a more interesting one that I'll address. You know, there's all sorts of consumption that's really worthwhile. Education is a great thing to spend money on. There's all maybe like gym memberships are a great thing for personal human capital maintenance, and those aren't tax deductible. So I don't think the idea is to tell anyone you should go to Wally World instead of getting a checkup. It's, in a sense, to leave that choice to people. The other thing is, our proposal isn't to tax all health spending. Our proposal is to tax health premiums on a family plan to the extent that it's above $27,600. And I think if you are spending more than that on a health plan, you probably are in the area where you're getting very little additional health benefit for those extra dollars, and with a little bit of pressure in the opposite direction, you could have just as good a health outcome, spend less money on health, and then be able to use your money for whatever you want, whether that's going to school or going to Wally World and going to the gym.
Jason, I want to ask you about revenue neutrality. That obviously was an important piece of the Bush tax panel. It was a key piece of the '86 Act. But in the political debate I'm hearing now, I don't hear a lot of people talking about revenue neutral tax reform. I hear Republicans talking about huge tax cuts. Senator Sanders is talking about big tax increases, at least on high-income people, and I don't hear about offsetting changes for lower-income people. How does that change the dynamic? What does that mean for discussions about tax reform going forward?
Look, as I said, I think if you are willing to violate revenue neutrality, it would make tax reform easier to do, but it would end the point of doing tax reform, which is to strengthen us as a whole. And I think in the business side, there has been a little bit more of a stickier presumption around revenue neutrality, and so that's part of what's attractive to that, is it gets you out of the debates on the individual side over the right level of revenue. One problem with revenue neutrality is that every dollar that goes to someone, comes from someone else. And we've seen that, for example, when you have a revenue neutral plan with a top rate of 25 or 28%, it's very hard, if not impossible, to do that and have the numbers add up without higher taxes on middle-class households. And I think that's now well enough understood that the desire to go out and repeat the same type of thing and propose a tax increase on middle-class households is maybe not as strong as isn't present.
Time for a couple more questions. Yes, sir, in the blue shirt.
Thank you, Larry Checco. I would just like to challenge this gentleman's assumption that the that corporations who are now sitting on trillions of dollars worth of capital are not increasing their salaries. They're buying back their stock, which is, I think, part of the problem. But the other thing I see is that what are the efforts to reclaim some of the incomes that's being held overseas by a lot of these corporations? It's my understanding that there's a lot of uncollected tax revenues that are just sitting in banks and foreign banks. Thank you.
So our proposal in that regard would be to have a one-time deemed dividend, a taxation on all that income that's overseas of 14%, and then on a going forward basis to reform the international tax system so you're immediately paying 19% on the money you make overseas. You get a tax credit against the taxes you've paid overseas, and thereafter you're free to bring the money, in and out, whenever you want. Bob Posen actually had, was one of the first to propose an idea along those lines. I don't want to blame him for any detail that we've gotten wrong, but I think things in that space that are somewhere between, you don't tax it at all, which creates a whole set of distortions in terms of shifting profits and possibly even production overseas, and you tax it all at U.S. rates in full immediately, which would also cause, a huge set of distortions in a world where our rate's higher than most everyone else's, and certainly higher than the lowest rate anywhere in the world, which to some degree is the right question for evaluating that. So going somewhere, in between the two of those. Roseanne Altshuler's written, Harry Gruber and others have written a lot about ideas along these lines too.
Time for one more question. Yes, ma'am. Hang on just a second.
Thanks. Reggie Oldak, National Women's Law Center. I understand you're talking about revenue neutrality. I'm a little confused, and I thought perhaps Howard's point about that being discussed less often now might lead to some discussion about positive revenue. Where do we get the money to raise the budget caps, to fund the priorities of the country, to support women and their families with the programs that they need to alleviate poverty, if we're focused on revenue neutrality?
Yeah, just to be clear, we have proposed, raising revenue, and we have proposed cutting tax expenditures, limiting them to 28 cents on the dollar across the board. And I should have put in a plug for that earlier, that I think there's been an increasing amount of traction in recent years for things that don't go item by item through the tax expenditures, but put them all into a basket and treat them the same way. And it's not like that's passed, but it seems like more people are interested in that than the other, so maybe we should keep riding that horse and seeing how far it gets us. So we've proposed that, and we've also proposed reducing spending on the spending side, including Medicare reforms, both in terms of payments and the structure of benefits. So a combination of revenue and spending to deal with the set of important issues that you raised. So we certainly would like to do that. When I was being asked about what there might be more of a near-term consensus for, that was part of why I was taking the individual side out of that near-term consensus. I don't think there's a consensus that we should raise individual taxes by $600 billion or whatever it is we've proposed over the next decade. There's not a consensus that we should cut individual taxes by whatever Republicans in Congress have proposed over the next decade either. That's why maybe wall that debate off, have more of a debate about what you can do on the business side, and there it isn't about helping businesses or hurting businesses. It's just about doing what we're doing today less stupidly. But I've had that theory for the last 6 years, and so far it hasn't materialized, but it does in some ways feel closer to me than it felt 6 years ago.
Okay, we're out of time. Jason, thank you very much for coming, and great to hear from you. Thank you.